Hey guys, in this video I'm going to teach you how to sell covered calls if you are a complete beginner. So just to preface, this video still requires a basic understanding of options. I have another video that you could watch just to get familiarized with the basics of options and understand as well as important concepts. That way when you listen to this video, it doesn't sound like a foreign language. But in this video, I'm going to cover a couple of topics. First of all, what are cover calls and why you should sell it, aka what is the benefits of learning how to do cover calls. And number two, also how to get started on selling cover calls by yourself after watching this video. Lastly, I'm also going to show a couple of trades, a couple of live trades that I've either done before in the past or I'm currently in the middle of, just to kind of familiarize you with the most important concepts, which is choosing a strike price and a date of expiry for selling cover calls. So without further ado, let's get started. So what are cover calls? Well, cover calls, if you recall from the options video, that in options, you can either buy calls or puts. So if you buy a call and the price goes up, call options appreciate in value. And then if the price of the stock goes down, call options lose value and they might go to zero. For a put, it will be the opposite. So if you buy a put, when the stock price goes down, the option starts to appreciate and gain more value. And then if the price goes up, the stock price goes up, the put contract starts to lose value and ultimately go to zero. So when you're selling cover calls, you're not dealing with puts, you're just dealing with cover calls. So when you're selling cover calls, the option that you're selling out there, it gains in value when the stock price goes up. So you're going to make a lot of your decisions based on the movement of the stock price and where you think it's going to go, whether it's going to appreciate or not. So why should we sell cover calls? What is the use of this strategy? Well, just like everything else in investing and trading, by selling cover calls, you can make more money for your portfolio, especially during times where you really can't do anything at all. So let's say you're holding onto a stock and you're waiting for it to appreciate. While it gets to the price targets that you want it to go to, you could be selling cover calls. Right now, as I'm making this video, it's April 2025, and right now we've gone through a couple of months of Trump tariffs. Trump's basically coming out with all these new tariffs, and there's really no logic or reason, and it's very unpredictable what tariff he's going to come up with next. So at a time like this, when you don't know what to do and a lot of your stocks are losing value, this would be a good time maybe to sell cover calls, because you're not able to do other things like swing trade or day trading and that kind of stuff. So essentially, just to recap, you would be interested in selling cover calls because you are able to make some passive income while you're holding your stocks in your portfolio. So next, how to sell covered calls. First of all, it's important that you know which accounts allow the sale of cover calls. So I'm just going to show you this with my own account here. So me being Canadian, I use Wealthsimple. And in regards to accounts, there's two types. There's registered accounts and non-registered accounts. So if you look at my account here, the account that says non-registered is the non-registered account. So you cannot sell any cover calls in a non-registered account. That means if you have a non-registered account here like me, you won't be able to sell any cover calls in here. So what kind of accounts could you sell cover calls in? You can sell it in eligible accounts or registered accounts. So in Canadian terms, it will be the TFSA. It would also be the RRSP. And thirdly, you don't see it on my account here just because I don't have it, but also you could trade or sell cover options in a margin account. That would be a type of non-registered that's used for margin trading. So the one that you see right here. So if I click this, a non-registered margin, this one will also let you sell cover calls. All right. After you have, let's say, the proper account set up, let's say I'm going to use my RSP account to sell cover calls. You want to buy the stock that you're going to sell cover calls on. Okay. So when you buy, there's this one main rule that I want you to be aware of, which is you have to buy 100 shares because in each one contract of options, there's 100 shares. So that's the minimum that you need to sell one contract of cover calls. So just make sure that you have 100 shares. So in my RSP right now, I have a couple of stocks where they're basically were bought for the purpose of doing of selling cover calls. So NVDL. So when I bought NVDL, I made sure I have at least 100 shares because that will be enough to sell one contract. And you will be selling contracts when you're selling cover calls. Okay, so make sure you have 100 shares. All right, next thing you want to do is you really want to choose stocks that are good for cover calls. Okay, there are some stocks that I've learned that are really good for selling for cover calls, and there are some stocks that are not so good. So some of the good ones that I will recommend would be like NVIDIA. Okay, so the NVDL that I was showing you earlier is basically NVIDIA. So if you read this one, it says Granite Share 2x long NVIDIA, NVDA. That's the ticker symbol for NVIDIA. That's how you know that what you're looking at here is basically NVIDIA. And even though it has a different ticker symbol, it moves more or less in the same direction and in the same way as NVIDIA does. So what would be a good stock? Like how did I know that NVIDIA is a good one for cover calls? Well, you can basically just take a look at the premiums and you can see use that to determine whether it's good or not. Okay, so if I were to click sell and open up cover calls, this is the option chain. So looking at the prices, what you have on the left here are the strike prices. So where you see like 37, 38, 39, 40, those are the strike prices. And then on the right where you see $2.18, $1.76, $1.23, $1.01, those are the premiums. And if you're not familiar, well, simple, how this reads is basically $2.18, you multiply it by 100. Okay, so basically $2.18 is basically $218 of premium. So just to recap what premium means, this is the price that someone's going to pay you to buy your contract. So this is the price that you collect if you sell cover calls. So for example, if you sell a cover call at a strike price of 37, like you see here, where the premium is 218, okay, you get a free $218 if you choose to sell the cover call. So that's the money that you keep, and it's yours regardless of what happens. Okay, so it's very important to determine whether a stock is good for selling cover calls or not when you look at the threshold between out of the money and in the money. Okay, because look at this one. The first one that's out of the money is 37 calls. And has a premium of 218, which is pretty good. Even if you went another dollar out of the money, like 38 calls, it's 176. You collect $176. 39, you collect $123, and then 40, you collect $101. Okay, so how do you know this is good? Well, look at the time. So at the top, it says here that I believe NVIDIA will rise within 5 days. Like you have between now and April 17th, if you are willing to sell the cover call for only 5 days, after 5 days, if let's say the contract is not exercised, these stocks are still yours. So basically, you just have to risk this on the options market for 5 days. That's actually a relatively short time. You can collect $218 if you sold a 37 call. Now let's just put that into context, okay? If you bought 100 shares like I did, it will cost you $3,500, $3,600, right? And then you sold a cover call, and then right from this $3,500 investment, you can make $218 within 5 days. If you extrapolate that to a month, okay, think about how much you're making in return from your investment. If you extrapolate that out to a year, think about how much you're making in return for that investment. So that's actually a really good number. And that's why we call that passive income. Okay. So again, back to the topic. How do we know this is a good stock to sell for cover calls? Well, the premiums are really nice. 218 is pretty juicy. 176 is pretty juicy for 5 days only. If I were to compare that to, let's say, a stock which I think doesn't have very good call options, I'll give an example. So relatively, I think SoFi is not as good for selling cover calls. Okay, let's pay attention to just where that line was back for NVIDIA, the line where the strike price goes either between in the money and out of the money. So the first one out of the money is the 11 strike price call. It's only $36. So between NVIDIA and SoFi, if you sold cover calls for 5 days, you get $218 for NVIDIA. If you sold a cover call for 5 days, you only get $36 for SoFi. Okay, this is the first. You can say that comparatively, this is the same amount of risk because 5 days is the same amount of time, and it's the first strike price out of the money range, right? Yet there's such a big difference in premiums. $218 versus $36, right? So that's how you can determine whether a stock is good or not to sell cover calls. So what I would do is I would also just explore other stocks and see which ones are good and bad for selling cover calls. So for example, if I were to look at Tesla, right? Selling cover calls on Tesla. The first out of the money for 5 days, again for 5 days, the first out of the money is $1,122. That's pretty good. Now, do keep in mind that each stock of Tesla is more expensive, but still, relatively, NVIDIA and Tesla, they have pretty good premiums in comparison to a stock like SoFi. Okay, here's another example of maybe a stock that I would say is not as good for options. So Google, for example. Okay, Google is also relatively more expensive, right? It's in the 3 digits, currently trading for about $160. The first out of the money is $312. Okay, which is not bad, but if you look at the second one, it all of a sudden drops tremendously to 195, to 114, to 64. And this is only 167.5. So I would say Google's not bad, but of the 4 that we've looked at, Tesla and NVIDIA are the best. Google is probably in the middle, and then SoFi is probably the least attractive to sell cover calls. So yeah, these are the most important things to keep in mind when you're choosing a stock to sell for to sell cover calls on. All right, so next I'm going to show you a few examples of trades that I've done in the past, just to fully illustrate the importance of choosing the right strike price and the date to expiry. Okay, so I'll start first with my NVIDIA. So I'm going to show you my NVIDIA and what's kind of happened with that one. So the strike price is very important. So one thing that I think, after seeing other videos out there and what they don't really teach you, is that you could also lose money if you choose the wrong strike price. So what is the wrong strike price? Any strike price that's below the price that you buy at. So what I mean is, if I buy NVIDIA 100 shares at $35, for example, okay? Actually, well, in this example, this one that I bought on April 2nd was $35.06. I have to choose a strike price above 35, okay? If I were to sell cover calls, okay, and I don't want to take a loss, sell cover calls at strike prices at 36, 37, 38, 39, 40, okay? Don't sell it below 36. Don't sell it at 35. Don't sell at 34. Don't sell at 33. Because before it gets more complicated, this is the best time to explain. If I buy at $35.06 and I have a strike price of 35, for example, that means on the day that the option expires, I have to sell it at 35. Would you want to buy a stock which you bought yourself at $35.06, but you have to sell at 35? You don't want to do that, right? You don't want to do it where you put a strike price of 34 because you bought at $35.06 and then you sell at 34, aren't you going to take a loss on that, right? Let's just go back to basic stocks, right? If you buy at 35.06, you don't want to sell at 20, you don't want to sell at 25, you don't want to sell at 30. And when we get closer to 35.06, you don't want to sell at 31, 32, 33, 34, 35, because in any of those scenarios, you lose money. Okay, so remember, a strike price is what price you're agreeing to sell at on the day of expiry. So 5 days from now, right? What price are you willing to sell at? It doesn't matter what the date is. You never want to sell your stocks, your 100 share of a stock, at a price lower than what you bought for. So just always make sure that your strike price is higher than the price that you yourself bought it for. So just to show you of a live trade myself, I bought at 35.06. The first covered sell I sold for was on April 3rd, which was expiring the next day, and it was a 35 call. Now, what do you notice that's a bit weird about this call that I bought? Do you notice how I broke my rules by buying this cover call? I just told you earlier that I bought at $35.06, and to never choose a strike price lower than what I bought for. 35 is lower than $35.06. So the strike price, the cover call that I sold here was very risky. But I decided to take it because even though 35 is lower than 35.06, the loss was minuscule, minimum, right? If you multiply that out to 100, if I bought at 35.06 and I sold a cover call at 35 and it went through, I would only lose $6, okay? But look at the premium that I gained for this one. On April 3rd, I got a premium of $90. So my $90.25 covered for my $6 loss if I had to sell at 35. Okay, so that was a risky one. Okay, I didn't really want to lose my 100 shares of NVIDIA. If NVIDIA the stock price of NVIDIA was lower than 35 on April 4th that day, I would have had to sell my options 100%. I mean, sorry, my stocks 100%, my 100 shares. And then if that happened at $35, I would have lost $6, right? But I still calculated, number one, the premium was just too good. In this scenario, the premium was just too good. It was $90 just to sell a cover call for 1 day. So I thought 1 day just to sell a cover call, I collected $90. And then on that day, fortunately, I think NVIDIA dropped to like 26, 27, 28. So at that price, the person who's holding the option, who bought it from you, they're not going to want to take your 100 shares at $35, because why would they buy your shares at $35 if the market stock price is 27, right? So that's why it didn't happen. So I think if you're just starting off with cover calls, make sure you're choosing strike prices above what you buy it at, and try to maximize the number of times you can resell your stocks for cover calls again and again. So this one didn't expire. That's a good thing. And then it's because next Monday, April 7th, I decided to sell cover calls again. Okay, this time I made it go out to April 25th. Okay, so on April 7th, I made it go out to April 25th. That's about two to 3 weeks. And then I was going to collect $150 worth of premium. Okay, so that means so far, if you look at this trade here, I bought NVIDIA on April 2nd, and by April 25th, not even a month's time, okay, like 3 weeks, I would have made $90 plus $150 worth of premium, which was $240, which I think is pretty good on a $3,500 investment, which is how much I spent to buy the 100 shares of NVIDIA. So this is the opportunity of cover calls, okay? As long as you don't break my rule of selling a cover call at a strike price lower than the price that you bought at, you're gonna be fine in every scenario, all right? All right, next one here that I'm just gonna show you, because you're probably wondering at this point, okay, so it's great, it looks like you sold a cover call and it never exercised, but what happens if it does exercise? Okay, so I'm gonna show you what happens in that scenario. Okay, so I also did a cover call on QBTS a while back in March. So just to look at what happens here, I bought 100 shares of QBTS at $4.80. So in total, that cost me, well, I bought a little more than that. I bought 105 shares. That's why it seems a little higher at 503. But basically, it cost me, let's say, 503.76 to buy the shares. I sold a cover call on the same day, and I collected a premium of $24.25, basically $25. It subtracts 75 cents because that's the price that the brokerage takes when you sell a cover call. And then the expiry date I chose was March 7th. So basically on that day, it was 3 days in the future. And then it was at $5. So I was willing to sell it at $5. So that is within my rules, right? Because I bought it at $4.80. So if I sold at $5, I wouldn't take a loss. In fact, any gain from $4.80, okay, to $5 here, I get to keep as well. Okay, so let me just reiterate. That's a really important thing you have to keep in mind. When you buy at $4.80 and you sell a cover call higher, let's say $5, okay, you get to keep the gain between the price you bought it at and the price that you sell. So in my situation here, I bought at $4.80 and I was willing to sell these shares at $5. That's a 20-cent difference between $4.80 and $5. I keep the gain from $4.80 to $5. Okay. So I get to keep any gain from $4.80 to $5, and I get to keep the $25, which is now $24.25 of premiums. That's mine. So with this cover call, as you can see, you can't lose, right? Now, let's go to that scenario. So eventually on March 7th, QBTS rose to $5.18. So let's think about that. The stock price of QBTS eventually got to $5.18. So what happened? I had to sell my shares at $5, right? Because the person who's holding this option has two options. They can either buy QBTS at the market price of $5.18, or they can buy my shares of QBTS at $5. Well, which one is a lower investment? Which one's a better deal? Obviously mine. So they bought my 100 shares at $5 when they could have bought it at a higher price on the market, and they don't want that. So that's why I lost my shares on March 7th, because someone was able to buy it at cheaper, which is $5, because the stock price was higher at $5.18. Okay. Now, in that scenario, would you freak out? Don't freak out, because as long as you follow my rule of selling cover calls at a higher price, okay, you don't lose any money. So in this scenario, I lost my shares, okay, which isn't a good thing. You want to keep your shares as long as possible, right? But in the end, I still gained because I sold at $5.70 when I kept the gain from $4.80 to $5, okay, and I also kept the $4.25 of premium. So in that scenario, I still was able to make a profit. So what was my only loss in this situation? Well, any gain from $5 to $5.80. And if you calculate that, that was only $18. So I basically gained, I gained the $24.25 and the gain from 503 to 570, so $67. I gained $67 for the movement from $4.80 to $5, and I gained $24.25. I lost $18. That is a great deal, right? So that in that scenario, what I'm trying to show you is even if you lose the shares, and that's what most beginners are afraid of when they sell cover calls, you're afraid that you lose your shares, right? Well, I'm showing you right here that as long as you choose the strike price above the price that you bought at, you can't lose. Your only loss would be two scenarios. Number one, you limit your gain when it sells, right? So I didn't get to capitalize on the gain from $5 to $5.18. I lost that, right? Which is not a big deal because I still gained from the premium and the gain that I had from $4.80 to $5. And I also, the second scenario where you can lose money on cover calls is if you didn't listen to my rules and then you bought the stock at a, I mean, sorry, you bought the stock and then you sold a cover call with a strike price lower than the stock that we bought it at. Okay, so if I bought a QBTS for $4.80 and I sold a cover call on it for $2, you put yourself at risk of losing money because you have to sell at $2 per share if you do a strike price of $2. So keep that in mind. So that's it for this video. I don't want to go any more in depth. I think if people are interested in this content and they probably have additional questions about this scenario or that scenario, let me know and I can make more videos in the future pertaining to that topic. But I think in terms of what I cover in this video, that's everything you really need to know to get started selling cover calls as a beginner. As long as you follow the rules that I laid out in this video, you're going to be fine. And again, this is not the know-all and be-all of doing cover calls. As you get more familiar with cover calls, more experience selling it, and also you start understanding the why I'm telling you these rules behind it, you will get better at it and you will start to develop strategies of your own. But I think if you follow this video, this is just to give you the basics to just get started and not lose money and be able to collect passive income from cover calls. So yeah, thank you for tuning in. See you in the next video.